Warren Buffett once said that when we own portions of outstanding business with outstanding managements, our favorite holding period is forever. But oftentimes, this is easier said than done. That's because good companies are hard to come by. If you look at the top holdings of the S&P 500, every few years, they tend to get replaced by some other companies. In fact, the average lifespan of a company is getting shorter and shorter. Back in the 1970s, the average lifespan of an S&P 500 company used to be around 30 to 35 years. But now, it has declined to less than 20 years. And it can seem like no matter where you look, you either find stocks that are super overvalued or have uncertain future. This can certainly feel discouraging, especially if you are a new investor who doesn't know how or where to start. That's why in this video, I'll be sharing with you my top 5 companies that I can buy and hold forever, and what makes them so special. Not just that, I will also show you how you can find out whether they are a good buy at the current price or not. Because buying a good company isn't just about the fundamentals, it's also about the price, where if you can buy a company at below their intrinsic value, you get the buy-in at the discounts, and this will give you a very good margin of safety. So with that being said, let's jump right into the first stock, Microsoft. When I look at all the Magnificent 7 stocks, I think that Microsoft stands out from the rest. Now, don't get me wrong, all the Magnificent 7 stocks are great companies and have a strong track record of delivering exceptional growth and innovation. But many of them come with some slight tinge of uncertainty about whether their strength can last forever or not. One example is Apple. Apple makes good hardware and has a very strong brand loyalty. However, their biggest income source comes from selling hardware. And even though they come out with new products year after year, their hardware revenue has stayed flat ever since 4 years ago. Yes, I know that their services revenue has been growing steadily, but it's still a small percentage of their revenue. So the fact still remains that Apple is primarily a hardware company and they deliver their services through their hardwares. And the thing about hardware companies is that even though when they are strong now, they can be disrupted if they fail to pivot fast enough. We have seen this happen many times in the past. For example, Kodak was a giant in film photography, but failed to adapt quickly to the rise of digital cameras. Similarly, while both Nokia and BlackBerry dominated the mobile phone industry in their prime years, they got disrupted when iPhones and Android phones came along. This could happen to Apple as well. That's why they need to constantly innovate to stay ahead or risk getting left behind. Then we switch over to Meta. Meta is an advertising company and almost 100% of their revenue comes from advertising. But while it's true that the advertising business is very strong across all their platforms like Facebook, Instagram, and even the recent Threads app, they face constant competition from other platforms such as TikTok, Twitter, Telegram, and Google. This puts them in a similar situation as Apple, where even though they are doing well now, it's hard to predict where they will be in the future. As for Microsoft, Microsoft is a totally different beast. Their revenue sources are almost evenly split across 3 business segments. There's the productivity and business process, personal computing, and intelligent cloud. None of their revenue is concentrated on any one segment, and each product is their own business by itself. As someone puts it, Microsoft is basically a tech ETF. Financially, Microsoft has been doing very well. For example, you can see that their revenue has been steadily going up over the past 10 years. Net income is also going up, free cash flow is also going up. Not just that, Microsoft is also a very profitable business. It has a rather high gross margin of 70%, and their return on equity is also rather high at 36%. But how long can this last? Can Microsoft continue to dominate far into the future? To answer this, we need to look at its economic moat. And economic moat is a company's ability to protect its long-term profit and market share from competitors. For this, Morningstar gives it a wide economic moat, which comes primarily from switching costs with network effects and cost advantages as its secondary moats. Microsoft is deeply integrated into businesses. 4 out of every 5 Fortune 500 companies uses Microsoft Office. Microsoft Office controls nearly half of the office productivity software market. 70% of organizations use Microsoft Azure for the cloud services worldwide, with almost 70 to 80% of Microsoft products generate recurring subscription revenue. All this gives Microsoft a very good long-term predictability of where they will be in the future. But then, is Microsoft a buy now? For this, you can find out by calculating its intrinsic value. But if you don't know how to, no worries. because there are a few different sources which you can check out. For example, Guru Focus shows that Microsoft fair value is around $358, which means it's a little overvalued now. Likewise, Morningstar also mentions that around $343 would be a 5-star price to get Microsoft. So if ever Microsoft drops back to this level, I will certainly look to accumulate more of Microsoft. Before we move on, if you would like to research more about the company, one easy way to do that is by checking them out via the Moomoo app. To do that, all you need to do is open up the stock that you are interested in, head over to the company tab, and here you'll find a ton of useful data. For example, it will show you the latest earnings results, analyst ratings, as well as free analysis from Morningstar, such as what is fair value, economic mode, what are the bull thesis, bear thesis, and more. Then further down, you'll find even more data, such as company valuation, revenue breakdown, as well as a quick financial overview of the company, all of which can help you make better decisions when deciding whether this is a good company to invest in or not. New users who sign up to Moomoo Singapore will get to earn up to $3,154 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for the US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Moving on, my next stock pick is Visa. Much like Microsoft, Visa is deeply integrated into businesses worldwide and is another one of those unique companies that just keeps getting bigger and bigger and will likely be around forever. But why Visa and not MasterCard or Amex? Simple, Visa is bigger than MasterCard lor. But for real though, both Visa and MasterCard are equally fantastic companies. The main reason I chose Visa is just simply because it has a wider reach and is unlikely to be disrupted anytime soon. As for why not Amex, Amex is a little different as it is both a card issuer and a payment network. So they will face competition not just from Visa and MasterCard but also from other payment providers such as Citi, Chase, Discover, PayPal, and so on. Right now, only 16% of global population is using credit cards. But as the population gets richer and richer, they will eventually want to start using credit cards or debit cards to make their purchases and earn rewards, which will benefit Visa. Also, with the rise in crypto technology, rather than seeing it as a threat, Visa is future-proofing itself by embracing the technology and integrating it into its ecosystem. Looking at Visa's financials, you will again see a very similar growth trend here. Revenue has been steadily going up over the past 10 years, net income going up, free cash flow is going up as well. Visa is also a very highly profitable company with an 80% gross margin and 14% ROE. As such, it shouldn't come as a surprise that Visa is trading at a premium now. According to Guru Focus, Visa's fair value is at $240, which means it's currently trading at about 30% higher from its fair value. Meanwhile, Morningstar puts Visa's 5-star price at $202, a level which will be almost impossible to reach unless there's another huge market crash. Next, my third pick will be ASML. When we talk about AIs and semiconductors, we will often think about big names like Nvidia, Intel, and TSMC. But one name that we seldom hear about is ASML, a company that is a very critical part of the semiconductor industry. To put it simply, ASML makes a type of machine that uses extreme ultraviolet lithography to print advanced microchips. The machines are then sold to companies like Intel, TSMC, and Samsung to create their chips. But why did I choose ASML and not Nvidia? I think while Nvidia is definitely dominating now, it faces huge competition, not just from the existing competitors like AMD and Intel, but even from their own customers like Google, Microsoft, Meta, and Amazon. Because of that, even if Nvidia can continue to do well, they will still lose market share to their competitors. Meanwhile, ASML literally has no competition as they are the only company that's capable of making these EUV systems. They've spent billions of dollars to research and develop these systems. This gives them a significant lead over all of its peers. And this advantage will just continue to grow as ASML continues to invest heavily in innovation. Will there be any competition in the future? Maybe. For example, their nearest competitor, Canon, is coming out with their own manufacturing equipment called NIL, which could possibly take on ASML's EUV. However, it's worth noting that companies like TSMC, Intel, and Samsung had redesigned their fabs a decade ago to make them suitable for extreme ultraviolet. And this is a costly and long process, which means it won't be easy for them to switch over to a new system anytime soon, thus giving ASML a high switching cost mode. And what does ASML's financials look like? Again, it shows a predictable growth of revenue, net income, and free cash flow. Though, you may notice that over the recent 2 years, their free cash flow has been dropping. This was due to the temporary increase in capital expenditure. According to Guru Focus, this stock is trading near its fair value of $730. This was due to the stock plunging over the past few months after they had given lower forward guidance. While this seems like bad news now, just remember that ASML financials are strong and there's no one else that can take ASML's place. Plus, ASML has reaffirmed their 2030 goals have not changed, despite the temporary drop in demand. Though, with that being said, the semiconductor industry is cyclical and is always at risk of supply chain disruptions and delays. That's why, if possible, it will be even better if I'm able to get it at Morningstar's fair value at $528 instead. Next, I have Adobe. When people think of Adobe, they think of Photoshop, Premiere Pro, and After Effects. Looking at the revenue breakdown, yes, it's true that these products form their largest revenue source. This is their digital media segment, and they hold a large market share in the creative industry. But besides that, Adobe also has the digital experience, publishing, and advertising segments. These are things like the PDF, document signing, and marketing services. Many of these products have a wide economic mode in terms of switching costs. For many creative professionals, including me, once we have started using Adobe products, it becomes incredibly hard to switch over to something else. And it's not just because I have to relearn the whole thing all over again, but it's also because Adobe products have a lot more advanced features that no other product have. So even if Adobe raises their pricing, I have no choice but to continue paying and using them. One such feature that I'm referring to is their AI feature. So while there were initial fears that generative AI could make Adobe obsolete, the reality is that Adobe has fully embraced the technology by integrating AI into many of their products. From removing objects, generating images, to simplifying video editing and making creative visual effects a lot simpler. As such, it's not hard to imagine why Adobe's revenue has been increasing, net income increasing, free cash flow has been improving, while having a fantastic 89% gross margin and 12% ROE. Guru Focus has a fair value of $575 for Adobe, which means it's currently undervalued now. But given that there are concerns that Adobe growth may be slowing down, it's probably even better if I could enter Adobe at Morningstar's price of $354. Last but not least, I have Amazon. Much like Microsoft, Amazon is very well diversified in terms of the revenue source. There's the e-commerce business, AWS web hosting, advertising, subscriptions, and physical stores. Many of these segments give Amazon a wide economic moat. For example, while Amazon e-commerce is not that prevalent outside of the US, it is the most popular online marketplace within the US. And even though their e-commerce arm is not particularly profitable, it does help to boost their advertising and TV subscription revenue. Then of course, there's the AWS. AWS is a clear leader in the cloud services space. Its comprehensive service offerings, constant innovation, and extensive infrastructure means that it's extremely hard for the competitors to catch up. But when you look at Amazon finances, you see something interesting. While Amazon's revenue has been increasing steadily, both their net income as well as free cash flow are almost non-existent. Sure, there's a $3.3 billion free cash flow in the latest quarter, but it's tiny when compared to their $158 billion revenue. The reason for this is because Amazon's strategy is to always invest heavily into their infrastructure, such as building new fulfillment centers, data centers, and logistic networks. Not just that, they also constantly reinvest the money by doing R&D in new technologies such as AI, Alexa, and drone delivery. And they are always on the lookout to acquire new businesses, such as the Whole Foods and MGM Studios a few years back, while at the same time looking to expand into new markets and industries. Basically, they are trying to get their hands into every aspect of consumer lives and industries. And so far, it is working out well for them. That's why Amazon is such a popular pick among investors. though it's a little overvalued now, with Guru Focus giving it a fair value of $106, making it 100% overvalued at its current level. Though, on Morningstar, their 5-star price is a little higher at $140. So, those were my top 5 picks for companies that I would look to buy into and hold for the long term, if ever the opportunity comes. But do comment down below and let me know, what are your top picks? Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.